Hey traders, today is Tuesday, February 10th, and I'm Michael Boutros, Senior Market Analyst with StoneX, here for a quick multi-time frame look at the US dollar. It's been a pretty volatile start of the year. We saw a decline of nearly 3.9% off the January highs. Subsequent recovery extended more than 2.5% off the lows. And here we are once again testing the 2025 low close. We tried to break it a few weeks back. That was 96.98 on a close basis. We could not execute a weekly close below it. We're now trying to make another attempt at a drop. The damage from a technical standpoint is pretty severe with that move that we saw a couple of weeks ago. And the near-term risk does remain lower, but we're looking for some inflection near-term, near some support. We would need to see a close below 96.98 on a weekly close basis to get this thing really rolling. Keep in mind, we have some major event risk over the next few days. So here's what it looks like on the daily chart. Again, a 2.5% rally right off the low, fizzled out right at the 50% retracement of the November decline. That gives you resistance at 97.97, and that rejected. We're on a now third consecutive daily decline. We slid below the median line of this pitchfork. This is just a pitchfork that mirrors the basic slope off the November highs. That median line break does suggest we have further downside to go. Now, the monthly open resistance comes in at 97.18, and that converges right on the median line over the next few days. That would need to hold if we are heading lower, okay? Here's what it looks like on the 4-hour chart. A near-term slope, same idea here, just the slope mimicking those highs that we made right back there on January 26th. 3-point touch confirms the slope. If you add a pitchfork to that same gradient, you can see again that we broke through the median line yesterday right into the start of the week. Near-term support comes in at 96.48 into 96.65. You're looking at the objective 618 retracement of this most recent rally off the January low, and you're looking at the 2025 low close. That converges on the median line into Thursday. We would need to see a break below this zone to validate the resumption, the next leg lower in the US dollar. Broadly speaking, the focus is to look for some basing in the US dollar here in late Q1, early Q2, if the dollar is going to surmount any kind of meaningful recovery. So the focus over the next couple of days is what happens along that plane. If we break below that slope, you're looking for the resumption of the downtrend. Subsequent downside targets, you're looking at 95.60 into the low day close for January. That's 95.80, 20 pip zone right down there. The key zone of support comes in right around the 95 handle, 94.97 into 95.21. That's this 1,618 extension from the November high. That's the 100% extension from the broader decline off the 2022 highs. So the levels are pretty well defined on the downside. Again, weekly open resistance comes in at 97.70. And the 50% that caught the high last week is 97.97. A break there would suggest a resumption of this near-term uptrend that we've been in off the lows from last month. The yearly open is 98.24. Key resistance and bearish invalidation, the level that the bulls would need to beat to suggest that a more significant low is in, a larger recovery is underway, is right at the 618 retracement. That's 98.54. You got the August high day close, the May lows, that gives you right into 98.68. Right within that barrier is the 200-day moving average. So again, this is the key zone that we would need to clear to really dissuade and basically dispel any further downside pressure for the US dollar in the months ahead. So the levels are pretty clear. Bottom line, initial resistance right at the monthly open, that's 97.18. If the US dollar is heading lower on this stretch, rallies should be limited to the weekly open at 97.70. Key support near term 96.48. We need to see a close below that to mark resumption of the downtrend. Do have some major data on tap over the next couple of days. Later today, we do get retail sales data out of the United States, but more importantly, tomorrow we get those non-farm payroll report from January. Remember, this is the delayed report on account of that government shutdown. So that's going to be critical on a Wednesday. And then right into the close of the week, we get the consumer price index and an update on the inflationary outlook. We are expecting a downtick on the headline read from 2.7 to 2.5. So this is going to be critical as traders continue to reprice Fed fund futures and basically interest rate cuts moving ahead. Remember, we discussed last week that for all intents and purposes, Jerome Powell is now lame duck. Kevin Warsh is going to be taking over. No expectations from the market for any cuts until June. And obviously, Powell's term ends in May. So the data will be critical as we get into the latter part of this week. We'll try to keep you updated, as always, on MB Forex on X. Till then, best of luck trading. We'll see you tomorrow. Cheers.